Over and over again, I see ICT traders make the same mistake when they're trading. You are using too many concepts. You do not know how to piece these concepts together. If you work a 9 to 5, you do not have the time to be on the 1 minute time frame. So today I'm giving you guys who work a 9 to 5 a real working model, one that I teach my students all of the time. This model allows you to trade on the higher time frames with accuracy and with precision. The easiest thing and the best thing about it is that it's mechanical. It's pretty mechanical to get an entry. So if you work a 9 to 5, watch till the end of this video and you will be able to trade this model alongside your job. Over time, this will build enough capital for you to quit your job. I was working in a warehouse whilst in university, just trading the higher time frames because I didn't have time to be on the lower time frames. Now I have the time to be on the lower time frames, but I only have that time because of this model. Let's not waste any time and dive straight into the model. So in essence, what we are doing with this model is predicting the weekly candle. Okay, because we don't have the time to be on these lower time frames, we only need to predict the next weekly candle. Now, if we do this and we use the right concepts to do this properly, you can get an entry on the 4-hour time frame. Entries on the 4-hour time frame allow you to catch that expansion whilst also not having to be on the charts all of the time. So what are we looking for, first of all, on the weekly time frame? Well, you are looking for the next candle to be predictable. So for example, if I go to the Nasdaq continuous contract, well, when we took out these lows down here, I expected to see a rally, and I was calling this to people. Now, when we do that, I'm expecting us to go bullish. And when we get confirmation of bullishness right here, when we close above this volume imbalance on this candle, 21st of April's weekly candle, that is confirming bullishness to me because we've hit my key level and we've closed above a premium level that in a bearish market I'd want to see respected. Now, we can now say the next candles are predictable. So what does the next candle do? Well, it trades into the down close candle and moves away. So we predict this candle to be bullish. Then we trade into and move away. Then we gap up and move away to the upside. We come into a key level, fair value gap on the other side, then the next candles become predictable. So every time we trade either into a discount array or into a previous weekly candle's low, the next candle becomes predictable. And how do we actually engage with that candle? So once you've established the next candle to be predictable, the way you engage with that candle is 4-hour stop runs. Every time we run stops on the 4-hour time frame, you can take a bullish entry. All right. And let me show you exactly what that will look like. So for example, here, we run a previous week low and we run it into a key level. Now you are looking for the same thing on a 4-hour time frame. Because we've had a 4-hour stop run inside of the new weekly candle, think about the logic first. What do retail do below old lows? Retail goes short. So when we take out these equal lows here, retail are shorting this. Where are their stop losses? At the high over here. So we know retail are going short with their stop losses up here. When we're predicting a bullish candle, all of that is very key. You have to be predicting the bullish candle and then you use the logic of stop runs. Stop runs are not just, they don't work for no reason. They work because retail trade them, right? Every stop run, every time we see a stop run, we're thinking bullishness. But what are retail thinking? They are thinking of going short, and they do go short. We have to now think, where are their stop losses? In this example, their stop losses would be up here. So every time we sweep a previous weekly low or we enter a key level, you look for 4-hour stop runs to get on side with that market. Now, fair value gap here holds. Now you're waiting for a fair value gap to get created, and it gets created over there. So we run the stops, we then displays higher, creating a 4-hour gap. You would take an entry there with your stop loss below the candle that created that gap. So you can stop loss there and target the highs. Why are we targeting the highs? Because that's where retail have their stop losses. So now every time we create a fair value gap, you are looking for price to fill that gap and move away from it. This is a redelivered rebalanced, which I'll dive into in another video. But also look what happens at this point. this candle here, 2 a.m. on the 4th of September, this is a swing low. So when we run below this swing low, what's happening? Retail are going short on the lower time frames. Where are their stop losses? Above here and above here. Okay? So because we're still predicting a bullish weekly candle, we're still looking for price to go long. And then you can catch big expansion moves after we either, on the 4-hour time frame, take lows, a 4-hour swing low, or we trade into, a fair value gap. And this happens over and over again. So when you're predicting a weekly candle, you are getting on side with that weekly candle through stop runs. And you will see it happen over and over again. If I go to the 4-hour time frame, because we're predicting weekly candles to be bullish all the way back here, you will see, okay, we take out previous week low on the new week. We take that out and then we displace higher. So every time we displace higher with actual displacement and we close above the premium levels you would usually want to see hold, now we can enter the market. For example, volume imbalance, okay? This volume imbalance after a stop run gets closed above. Now you would enter here on the return to the volume imbalance with your stop loss below there or below this low if you want to be more conservative. And think about what's happening every time we break below lows, all right? So we get 1 break below, 2 breaks below, and a third. Retail stop losses rest where? Above here, and above all of these highs as well. So it's not just random stop runs. It's the logic of breakout traders are trading short. They're going short when we're breaking lows. Now we are predicting a bullish weekly candle, so we target their stop losses. Every single time you will see this happen. So we look for a bullish weekly candle and we look for a 4-hour stop run just before or during that weekly candle. Now, again, if we go back in time to this example, you'll notice something. As we come down into the previous weekly candle, the down close candle that we traded above and closed above, in the new week, we want to see this down close candle on the weekly time frame traded into before running higher. And look what we are doing here. We're not just trading into the weekly order block, which I'll make orange so we can see it, right? This is the weekly order block, the orange line. We're not just doing that. We are breaking below old lows. 2 lows got tagged here, right? We broke below with momentum. Look at that. What do you think retail are doing when they see a down close candle like that? Break below lows. They're going short with their stop losses where? Above this high and all the way back here, right? So when we have the 4-hour stop run, you are now looking for what? Key premium raise to get disrespected. Then we create a fair value gap. Price hits it multiple times, giving you multiple entries, and we rally into the new week as well. So you could even drop time frame here on the 1-hour time frame and get in on a fair value gap, on an order block. It doesn't matter which. The point is it works because of the logic of breakout. So retail are seeing this as a breakout to the downside. We then use their stop losses to target and get on side with the market. Now, the whole reason and what I really want you guys to focus on is why this actually worked. This worked because this candle here was predictable. And if you made it into this video, this far into the video, then it's very important I make this clear, all right? Because a lot of people will have clicked off by now, but you guys are the dedicated ones. Listen to this. This only works when the next candle is predictable. Now, the astute pupil amongst you will be thinking about how they can fractalize this. But those of you who work a 9 to 5, if you only focus on that next weekly candle being predictable, then any 4-hour stop run that happens should be a long. And if you're predicting it to the downside, then it should be a short. But this is only predictable because of the logic back here. We took out sell stops from the marketplace. We took out previous week low, and then we rallied and closed above the down close candle. So what do we want to see down close candles do in a bullish market? Hold price higher. So when it gets closed above, we trade into it at the start of the week, giving you not only a 4-hour stop run, but it's giving you a weekly key level to key off of. We then rally higher, and this candle becomes predictable. So inside this candle, you are now looking for 4-hour stop runs and hourly fair value gaps. That's a little gem there as well. Dive into that one. So if you work a 9 to 5, this is truly all you need to be profitable. The problem most people will face, and some of you will face, is that you can't wait if it's not predictable. If the candle is not predictable, guess what you do? You wait. If you are able to wait when those candles, those weekly candles, are not predictable, then at the end of the quarters, you will become profitable. Stop thinking at the end of the week. Start thinking at the end of the quarter. Are you profitable at the end of the quarter? When you start thinking like that, your trading will change. If you did enjoy this video, please do drop a like. Grab my free course, it's the first link in the description. I dive into this more on there about predicting the weekly candle. So if you want to learn exactly how to predict the weekly candle, my free course is about 5 hours long. It is in the top link of this video. All right, grab that over there. Now, with that being said, I thank you as always for watching, and I'll catch you guys in the next one.